The beginning. $1. That is what one Bitcoin cost in April of 2011. Not $100. Not 1,000. $1. As of early 2025, a single Bitcoin was trading above $100,000. That is not a typo. That is a 100,000 to 1 return in roughly 14 years. The greatest price appreciation of any asset in recorded financial history. And yet, half the world still doesn't know what it is, and a small but growing number of the wealthiest institutions on the planet are now quietly moving billions of dollars into it. So, what exactly is Bitcoin? Where did it come from? Who is telling their richest clients to own it, and how much? What is the 4-year cycle that is played out like clockwork every single time? And what are the real threats to its existence? Where Bitcoin came from. October 31st, 2008, someone published a 9-page document to a cryptography mailing list. The author went by the name Satoshi Nakamoto. The paper was titled Bitcoin, a peer-to-peer electronic cash system. Nobody read it. The academics who did said it couldn't work. The first time Bitcoin was used to buy something, it cost 10,000 coins. In May 2010, a programmer named Laszlo paid that amount for 2 pizzas. At today's prices, that is a $1 billion lunch. Laszlo is fine. He has never expressed regret. That day is still celebrated in the crypto world every May 22nd as Bitcoin Pizza Day. When capital markets showed up for the first several years of its existence, Bitcoin lived almost entirely outside traditional finance. It traded on unregulated exchanges, it was used on the dark web, and it was dismissed by virtually every major financial institution on the planet. That started to change on December 10th, 2017, when the Chicago Board Options Exchange, the CBOE, became the first regulated U.S. exchange to launch Bitcoin futures contracts. 8 days later, on December 18th, 2017, the CME Group, the world's largest futures exchange, launched its own Bitcoin futures. For the first time, institutional investors could get regulated exposure to Bitcoin's price without ever touching the underlying asset. They could now go long or short on a regulated exchange. On January 10th, 2024, the U.S. Securities and Exchange Commission approved the first spot Bitcoin exchange-traded funds in American history. 11 of them launched simultaneously, from BlackRock, Fidelity, Franklin Templeton, WisdomTree, Archie Invest, Invesco, VanEck, Bitwise, Grayscale, and others. These are ETF funds that held actual Bitcoin, custodied by regulated institutions, tradable in any standard brokerage account. In the first 5 days of trading, these ETFs saw nearly $1.25 billion in inflows. BlackRock's iShares Bitcoin Trust alone pulled in $1.7 billion in its first week. By late 2024, Bitcoin ETF trading volumes had surpassed $500 billion since launch. By early 2025, BlackRock's fund had crossed $45 billion in assets under management, making it one of the fastest growing ETF launches in history. What the ETF approval actually did was remove the last major structural barrier between Bitcoin and the wealth management industry. Before January 2024, if a registered investment advisor wanted to put client money in Bitcoin, they faced enormous compliance friction. Now, Bitcoin sits in the same account on the same statement alongside the client's stocks and bonds. What wealth managers are telling their clients. In August 2024, Morgan Stanley became the first major wirehouse in the United States to authorize its financial advisors to proactively recommend Bitcoin ETFs to wealthy clients. Initially, the threshold was a net worth of at least $1.5 million and an aggressive risk tolerance. By October 2025, Morgan Stanley dropped those restrictions entirely, authorizing its more than 15,000 advisors to pitch Bitcoin ETF exposure to any client in any type of account, including retirement accounts. Bank of America's Merrill Lynch authorized its advisors to recommend Bitcoin ETF products beginning January 2026. JP Morgan, which for years was led by a CEO who called Bitcoin a fraud, now allows clients to buy it and has accepted BlackRock's Bitcoin ETF as loan collateral. Charles Schwab has published formal allocation guidelines recommending up to 5.6% in an aggressive portfolio. Goldman Sachs holds billions in crypto exchange-traded products. What percentage are the advisors actually recommending? The data from a 2025 Bitwise survey of financial advisors tells the story. Among advisors who currently allocate to crypto, 47% hold between 2 and 5% in client portfolios. 17% allocate above 5%. BlackRock's own research, published in December 2024, put the optimal allocation range for long-term investors at 1 to 2%, noting that even a small allocation meaningfully improves risk-adjusted returns due to Bitcoin's low correlation to traditional assets. The practical consensus forming across the wealth management industry is this: 1 to 5% for most clients, with the specific number driven by risk tolerance and time horizon. The returns, the best performing asset in history. Bitcoin launched with a price of effectively zero in 2009. It first crossed $1 in 2011. It hit $10 in 2012. It crossed $1,000 for the first time in late 2013 before crashing more than 80%. It crossed $20,000 for the first time in December 2017 before crashing again. This time by roughly 84% to around $3,000 at the bottom of the 2018 bear market. It crossed $69,000 in November 2021 before collapsing nearly 77% to $16,000 in 2022. Then it crossed $100,000 for the first time in late 2024, reaching an all-time high above $126,000 in July 2025. From 2011 to 2021, the average annual return for Bitcoin was approximately 230%. That is 10 times the annualized return of the NASDAQ 100 over the same period. The NASDAQ 100 itself was the second best performing major asset class in the world. Bitcoin has outperformed every major asset class in 10 of the last 15 years. The 4-year cycle, and why it keeps working. There is a mechanism built into Bitcoin's code that drives everything about its price behavior. It is called the halving. Here is how it works. Every time 210,000 blocks are added to the Bitcoin blockchain, which happens roughly every 4 years, the reward paid to miners for processing transactions is cut in half. When Bitcoin launched in 2009, miners received 50 Bitcoin per block. In 2012, that dropped to 25. In 2016, 12.5. In 2020, 6.25. After the most recent halving in April 2024, it dropped again to 3.125 Bitcoin per block. After 2014, no new Bitcoin will ever be created. What the halving does is reduce the rate at which new Bitcoin enters the market. If demand stays the same or grows and supply growth slows, basic economics says the price goes up. The first halving was November 28, 2012. Bitcoin was trading around $12. By the end of November 2013, it had reached roughly $1,150. That is a 9,000% gain in 12 months. The second halving was July 9th, 2016. Bitcoin entered the cycle around $650. By December 2017, it had reached nearly $20,000, a gain of approximately 2,800%. The third halving was May 11th, 2020. Bitcoin entered the cycle around $8,500. By November 2021, it peaked just under $69,000, a gain of approximately 700%. The fourth halving occurred April 19th, 2024. Bitcoin broke its prior all-time high before the halving even occurred, something that had never happened in a previous cycle. By July 2025, it had reached a new record above $120,000. Every single time a halving has occurred, the pattern has repeated. Accumulation, parabolic rally, speculative peak, significant correction, recovery, and then the next cycle begins. Every single time, people have said it was different this time. Every single time, it was not. Scarcity, lost coins, and the digital gold argument. Bitcoin's supply cap is 21 million coins, period. Hard-coded, unchangeable. No central bank, no government, no company, no person can ever create a 21 million and first Bitcoin. This is the core of the scarcity argument, and it is the reason Bitcoin is increasingly compared to gold. But the actual available supply is even tighter than those numbers suggest, because a significant portion of Bitcoin that has been mined is gone. Permanently, irretrievably gone. Chainalysis, the leading blockchain analytics firm, estimates that approximately 3.7 million Bitcoin are permanently lost, locked in wallets where the private keys no longer exist. River Financial's 2024 analysis put the figure at 3.8 million. Other estimates range from 2.3 million at the conservative end to 4 million and above. That is between 11 and 19% of the total supply that will ever exist, vanished forever. The stories behind those lost coins are remarkable. James Howells, a Welsh IT worker, accidentally threw away a hard drive in 2013 that contained the private keys to 8,000 Bitcoin, worth more than $800 million as of 2025. He has been fighting the local council ever since for permission to excavate the landfill where it ended up. They keep saying no, and James has officially stated that he has given up trying. What this means practically is that the actual liquid supply of Bitcoin is likely somewhere between 15.8 and 17.5 million coins. Every Bitcoin you hold represents a larger share of the real-world supply than the nominal math of 21 million would suggest. This is the digital gold argument. Gold is scarce because the earth only contains so much of it, and mining more is expensive and slow. Bitcoin is scarce by design, with a supply schedule that is more predictable and transparent than any physical commodity in history. After the 2024 halving, Bitcoin's annual supply growth fell below 1%. The case against Bitcoin. Real risks, real critiques. Bitcoin has experienced 8 separate drawdowns of 50% or more since 2011. In 2022 alone, it fell 77% from its all-time high. Since 2015, it has experienced 34 separate bear markets. The S&P 500 experienced 2 in the same period. If you bought Bitcoin at the wrong time and needed that money within a year or two, you were in serious trouble. Volatility is a defining characteristic of Bitcoin. Governments have the power to restrict, tax, ban, or otherwise complicate Bitcoin ownership and trading. China has banned it multiple times. India went back and forth on its legal status for years. El Salvador made it legal tender and then walked that back under pressure from the IMF. In the United States, the regulatory environment has improved dramatically, but administrations change. A future SEC, Treasury, or Congress that decided to get aggressive with Bitcoin could create significant disruption, even if outright prohibition is unlikely given how deeply it is now embedded in the financial system. This is the one that keeps serious people up at night. A sufficiently powerful quantum computer running Shor's algorithm could theoretically derive a private key from a public key. Meaning, if a quantum computer powerful enough ever exists, it could figure out the password to any Bitcoin wallet whose public key has been exposed on the blockchain. That includes every wallet that has ever sent a transaction. Conclusion. Bitcoin is 16 years old. In that time, it crashed more than 70% 4 separate times. It has been banned by governments, attacked by regulators, exploited by criminals, and dismissed by some of the most respected investors in the world. It has also survived all of it, and every time it came back higher. Whether that pattern continues depends on things nobody knows with complete certainty. The pace of quantum computing development, the direction of global regulation, the behavior of institutional capital, and ultimately whether the next generation of wealth decides that a fixed supply, decentralized digital asset is worth holding alongside their stocks and their gold. I'm not here to tell you to buy it or to tell you to avoid it. I am here to make sure that whatever decision you make it with the full picture in front of you. If this video gave you something you didn't have before, leave a comment below. Like, subscribe, and hit the notifications tab if you already haven't. And share this with someone who keeps asking you about Bitcoin and doesn't know where to start. If you like this video, you may like this next one in the top left corner.